Today we're going to be focusing on rental property. What is a deduction, what deductions are important, and how we can keep track of those deductions. Hi everyone, Stephen Hamilton here for Tax Talk. I want to thank the Kwok brothers for having me here. I know they've been getting a ton of feedback that you guys have tax questions. So they invited me here today to talk about the different deductions for rental property. Before we get started, I want you to hit the subscribe button below, leave a couple of comments about topics you want to hear about, and don't forget to share this video with your friends and family. I have a lot of individuals that come to me and ask questions, and I know they get a lot of questions as well. So we thought this was a great idea to teach you some of the basics. So your rental property, everybody's worried about what their rental income is and how they're going to pay taxes. You only end up paying tax on your net rental income. So we take your income minus your deductions equals your net rental income. That net rental income or loss is what will factor into whether or not you get a tax benefit or if you get a tax bill. Now, the biggest and easiest thing to start out with is your gross rental income. Your rental income in and of itself is going to include all of the rents that you received, even if they were prepaid for the next year. We don't include security deposits. Security deposits are not taxable income. They're simply a reserve that is kept there because that money does not belong to you, the landlord. The point at which it does become income and we have to include it in income is going to be that day when the tenant moves out and you write them that letter saying, here are the items that I'm deducting for repairs on the rental. So we are not giving you your security deposit back. That's when you would include some or all of your security deposit in income. That's really kind of our basics. So it's going to include any and all receipts. If you receive reimbursements for bills, reimbursement for utilities, repairs, etc. Those are all going to be rental income. The next item we're going to talk about is rental deductions. Now, most people say, okay, well, you can pretty much write off anything that's related to that property. But what does that really mean? Those write-offs are going to start with ordinary and necessary items for your rental. So I have a lot of clients who what they do is they might, at Christmas time, they might give each of their tenants a holiday ham, or they give them a $25 gift card. That's a common goodwill business gift and deduction. But we have other items that we're going to look at. Some of those are going to be repairs, maintenance, we have improvements, we have commissions, we have legal fees. There's a wide variety of items. So one main item I'm going to start with here is our cleaning and maintenance. So for my properties, I have a landscaper that comes through and cuts the grass, maintains the whole landscape. That's an ordinary and necessary deduction. We have to do that. We have to maintain our property. We have to keep it clean. So my cost for that is going to be a deduction. And I'm going to be able to list that right there on my Schedule E under cleaning and maintenance. Then I might have somebody who comes in and touches up the paint on the outside or cleans out the gutters, different items like that. That's also going to be part of my maintenance. And that's a legal deduction. We have other deductions. We have repairs, we have supplies, we have insurance. Insurance is going to be a deduction. Our supplies are going to be a deduction. Anything related to and for the benefit of that building is going to be a regular deduction. The big area that we get a lot of question about, there's two. The difference between repairs and improvements and then depreciation. Depreciation is a detailed calculation that I'll try to touch on in the end here a little bit, but that's really content for another video. So make sure you tell the Kwok brothers that you want me to do a video strictly on depreciation for you guys. And you can put that down in the comments below. Repairs versus maintenance is probably going to be a big, huge one that I'm going to touch on. Repairs are your everyday, the faucet broke, the mailbox broke, I need to replace a door handle or a light switch. That's a repair. Your maintenance items are going to be the ongoing, regular, occurring items that you have happen. Improvements. Improvements are the tricky ones. So if I have a driveway that's gravel and I decide I'm going to replace that with concrete. A lot of people are going to wonder if that's a repair or if that's a maintenance item. Well, or improvement item, sorry. That is actually going to be considered an improvement item. And then depending upon the cost of that, if it's more than $2,500 or less than $2,500, is going to determine if I can just take it as a repair. Now, so let's say that driveway cost me $3,000 to put in, and I upgraded from gravel to concrete. In that situation, I am going to be looking at having to depreciate out that driveway. Now, normally that would be depreciated over a total of 15 years. I know that sounds like a lot, but luckily our tax code has some benefits in it right now under the Tax Cuts and Jobs Act. I can actually accelerate that depreciation. I still have to list it as a depreciation item, but I can accelerate that deduction 100% into the current year, which means I will get a full deduction for that $3,000. But let's say that that driveway, small little parking pad, cost me $2,400, so $2,400. I can actually consider that de minimis and too small for me to have to depreciate. So I can actually then expense that as a repair. And that's caused a lot of confusion over time here. So I like to kind of give that explanation where we look at that threshold of $2,500 or not to determine if we even look at whether it matters as an improvement. So first look at $2,500. Is it above or below? If it's below $2,500, we can expense it. If it's above $2,500, I have to determine if it's a repair or an improvement. So I'll give you an example. A tree falls onto my roof, and it costs me $4,000 to fix it. That $4,000 that I have to repair the envelope of the house, even though I might use a slightly better grade shingle, is still going to be a repair. I am returning the property to its original condition because of a defect. An improvement would be, okay, the roof is about due to be replaced, and it's going to cost me $15,000 to completely strip it, resheet it, tar paper, shingles, the whole works. That I'm going to have to depreciate over 27 and a half years. So there's a common, an easy way to kind of think about that. Does it improve the lifetime of the property? If it improves the lifetime of the property, I'm going to be looking at it being an improvement and have to be depreciated. That's kind of the basics on repairs versus improvements. Thank you everybody for joining me for tax time today. What I want you to do is I want you to hit that subscribe button, leave me a couple of comments down below. If you have a couple of questions, you're welcome to list those there. But make sure you subscribe, share this video. You can share it on Facebook, you can share it in groups. I just want to get good quality information out for everybody. But make sure you subscribe, make sure you give us some feedback, and let us know what topics you want us to talk about.